All right, this is take two. Welcome to another edition of CapWealth On. They said I didn't smile when I started the first time, so we had to start over again. Anyway, it's good to be here. I wanted to start this session of CapWealth On, the March edition, with a question that we will answer at the end of the session. And it's a question that we get a lot. And so as we go through this little presentation, like I said, we'll answer the question at the end. And the question we're getting right now is, given all the uncertainty in the world, why wouldn't we just put all of our money into Treasury bills? Something that people typically deem as safe. So that's what we're going to answer through this session, and I'll have a real succinct answer for you at the very end. So to unpack that and get a better handle on what that means, why we wouldn't just put all of our money into treasuries, we first have to go back and look at where we are in the last 10 to 14 years, what we've done this year, and how we're positioned to help you meet your financial goals and objectives in the future. So you go back the last 10 to 15 years, you'll notice that one of the recurring themes that we've had with all of our clients and how we reflect that theme in the investment strategies that we've had for you is that bonds are dangerous. Bonds that pay no interest, zero interest, or close to zero interest in an environment with inflation building, they're dangerous. They serve no purpose whatsoever. And January 9th of 2023, for the first time in the last 14 years, we actually started moving some of your assets into fixed income. Why? Because cash became an asset again. Cash started paying 4.5%, 5% on safe United States Treasury bills. United States Treasury bills are guaranteed by the full faith and credit of the United States government. Not 250,000, but $1 million, $2 million, $100 million, $5 million on up. There is no distinction. So your $30,000 or $50,000 or $500,000 investment in a United States Treasury bill, again, is backed by the full faith and credit of the United States government. One of the other things that we have talked about, but talked around, and now it's kind of exploded onto the scene, is this whole concept of duration. And duration is what defines one of the major factors that defines risk in a fixed income investment. So if you have a 10-year bond and you have a fixed rate like the 10-year Treasury was in December of 2021, and it was 0.7%, you're going to get your original investment back in 10 years, and you're going to get 0.7%. But what happens if you decide you want to sell that Treasury in between now when you purchase and maturity? You're either going to get, three things are going to happen. You're either going to get what you paid for it, less than what you paid for it, or more than what you paid for it. And so that duration risk, if rates on that 10-year Treasury go up to 4.5% to 5% like they did 2 to 3 weeks ago, then the value of your underlying investment has gone down, and you will have to wait till maturity to get your money back. Well, what I've just described essentially is what happened to SVB Bank and Signature Bank. They both failed, and it's the first time in the history of the financial markets that a bank has failed, multiple banks have failed, not because of credit issues that we traditionally think of as risk in a bank, but because their assets and liabilities didn't match up. They had invested in bonds with long durations that they couldn't sell. And in the case of SVB Bank, it illustrates the point perfectly. They lost $42 billion worth of deposits in a 3-day period. They had to sell their available for sale portfolio, which is marked to whatever the market is, and they lost over $2 billion. And so you see the risk in bonds. Number one, they never met any objective relative to inflation. There was no real return relative to inflation. And at the same time, the duration risk, the longer maturity, made them very, very risky from the standpoint of the regulators. They just didn't have enough cash to meet their obligations. And that's the story of the bond market in 2023. For the first time in close to 15 years now, the market's woken up and they've started to understand there is risk in bonds. And so against the grain of what was conventional thinking, we had none of your money in bonds. In fact, we told you, take the money, put it in your bank. We don't want to charge a fee on it. It's safer at a bank, because they were paying at the time maybe 1%, 1.25%. The money market fund at Charles Schwab was paying 0.5%. And then towards the end of 2022, as rates rapidly rose, we had 9 consecutive increases, and I think now this latest one would be 10 consecutive increases in interest rates over a very, very short period of time. And so Treasury bills, very short term, 3, 6, 9 month, a year, 2-year Treasury bills, they became a viable asset class again. And so January 9th of this year, we took anywhere from 12 to 18 to 20% of our clients' money. And we trimmed holdings in banks, we trimmed holdings in virtually everything we had, and we bought, a 90-day Treasury bill. It'll roll over at the end of March. We're going to roll that back over into another Treasury bill. We buy them at the auction at Charles Schwab, so there's not even a transaction cost to do that. And then we break them down into each of your individual accounts. So Treasury bills became a strategic asset. It became another tool that we had in the toolbox that would dampen volatility and give you some comfort. We never want people to be in a position where they have to liquidate an investment to match up what they need to live on a daily basis. One of the things we spend a lot of time with here, because our clients have gotten older, we're managing fixed income, we're managing distributions to fund lifestyles, is that we now have additional tools where we can do that. So whereas 5 years ago, we were telling you to put your money in a bank, now we're open back up for business on short-term Treasury type of investments. We can do a better job managing your cash than a bank can right now, especially with the uncertainty around whether or not they will cover anything over $250,000. And I believe they will. The strength of our banking system has to eliminate any concern or any risk that you have as money that flows through the system is somehow at risk. And so the regulators are now going to be working, very hard at reassuring and providing that confidence. It will be something like payroll insurance protection, any number of things that will go beyond just the traditional $250,000 protection for an individual, for an individual account. So that's the state of play on where we are right now. The bond market was dangerous. We avoided it. We are now looking at fixed income as an opportunistic way. But in the near term, we've got a lot of Treasury bills. We've built cash buffers, and that is a good place to be. And it'll be reflected in the returns in your accounts. whereas you will not experience the downturns that have been caused by this dislocation and the problems in the bond markets and what it has done to the balance sheets of banks. And then the second component of that is we have focused on a lot of really strong companies, strong balance sheets, dividends. They won't have access to the capital markets. We have only one company right now in our portfolio, and we're evaluating it very closely, that even has any concern whatsoever about being able to refinance obligations that occur 5 years from now. The rest of the companies that we have no such type risk in the portfolio. You're always going to have one, and we're very confident, we believe at this point, that the company that we're examining, we'll talk more about that later once we have the final information on it. We're confident that they're going to weather the storm and do very well. So that still doesn't answer the original question of why don't we just put everything in Treasury bills, turn off the news, and let this period of uncertainty that creates a lot of heartburn and a lot of discussion, let it pass? And the answer to that is it's inflation. And I can't articulate this enough. The number one threat to every investor is and will always be inflation. And the battle that you have over a long-term retirement and the intergenerational transfer of wealth is how well you do in having your assets grow with or ahead of inflation. We see this every day. We've got 90-year-old people now that have been clients for 30 plus years that thank us every day because now they have the money that they need for their assisted living, for the expenses that they incur with medical. And we, are very proud of that. But that goes back to discussions that we had and strategies that we laid out all the way back into the 80s and the 90s and the last 22 years, and since 2000. Everything is geared towards inflation. Well, let's put some numbers to that conceptually so why you understand it. Well, March was a birthday month for me, and one of my clients sent me this happy birthday specialty form. It was prepared just for me. And it goes back and it compares the price of everything in 1957, and do the math, to where it is in March of 2023. So a gallon of milk, 1957, was $1. It's $4.18 a gallon today. A loaf of bread was 19 cents. It's $1.81 today. Here's a good one. A new car in 1957 was averaged $2,100. Today, it's almost $34,000, average new car. Price of a gallon of gas, 24 cents. Nationwide average $4 a gallon today. How about the price of a new home? $20,000. Average price of a new home is $429,000 today. People are paying more for a car than they paid for a new home in 1957. And incomes, this is another biggie, $4,594 average income in 1957. Today, average income is $53,924. This morning, they made an announcement about Disney signing a new labor contract that guarantees a minimum of $18 an hour for everyone that works in a Disney park. That's the minimum wage. Well, the minimum wage, try and live off of $18 an hour. TSA advertises for security people starting at $18 an hour. $18 an hour, 160 hours in a month. After you take out FICA tax, everybody pays FICA tax. Let's say there's no federal income tax attributable. That's $2,350 a month. Now, let's say it takes you $400 a month to get to and from work with your car expense and fuel expense, and that's pretty reasonable. You're not living too far from where you work when you do that. That leaves you with a little less than $2,000 a month for everything else. Average rents in Williamson County are $1,500 to $2,000 a month minimum. So you can see the problems that people have and why inflation is going to continue to be a problem in the near term. But here's the real answer to the question. The Dow Jones Industrial Average in 1957 was 435. Today it's 32,000. So if you invest in a way that protects you against inflation, like long-term investments in the financial markets, good, high-quality companies that have products and services that they have the ability to raise their prices and sustain themselves through inflationary environments. If you're invested that way, then you're going to win the battle with inflation. Last week, I was at a Barron's event, and noted economist Jeremy Siegel, who I had as a professor at the Wharton Securities Industry Institute in 1992. He was the keynote speaker. I was fortunate enough I was able to sit next to him. We talked about a variety of things. And he's been very, very critical of the Fed. And the one takeaway you can get from a discussion with him, in fact, he's anytime you can listen to him, he's a very, very brilliant man. He started his career as an associate professor at the University of Chicago. Milton Friedman was one of his colleagues. They became lifetime friends. This is the first time since 1981 that we haven't had the head of a Federal Reserve come from academia or have a background in economics. In a very simple way, he just outlined mistake after mistake after mistake that the Fed has made and Congress has made that has brought us to this situation where we're at with inflation. And there is a direct correlation between the amount of money you print and the amount of inflation that it creates. Now, that's a simplification of some really difficult mathematical equations that Professor Siegel would take you through. But that's essentially what he said to the group. And the Fed has compounded that problem by setting a 2% target for inflation that makes it very difficult. And it's going to take another 3 or 4 years to bring inflation down. He believes inflation will come down based upon global demographics. We don't have the push like we had in the 60s, where you had the baby boom generation and large population growth, both domestically here and abroad. China has a negative growth rate now, 2 consecutive years in a row. We are barely sustaining our growth rate. And so those are the factors that he thinks will lead to, over time, interest rates coming back down and settling at a more reasonable level based upon what we've had in the last, compared to what we've had in the last 10 to 15 years. But there will be a real return. But nothing will compare, in his opinion, with inflation and investing in the stock market long term. Since 1802, the compound average annual rate of return in the financial markets, as expressed in what I talked about with my birthday month, is 6.7%. And every other asset class that you can invest in is substantially less than that. Gold, for example, compound average annual rate of return since 1802 is less than 1% per year. So while all this fear, all this uncertainty, all this swirl where everybody's got an opinion is being thrown out there, we're staying very, very focused. And even to Professor Siegel's point, after we get through this and we settle down with more leveled out interest rates and a more wholesome, if you would, bond market where bond investors are getting some type of return that maybe even matches inflation, it won't exceed inflation over the long term, you're still going to have inflation that's going to average somewhere around 3.5%, which is the 40 to 50 year long-term average. So inflation's here to stay. Investing for the long run has to incorporate the risks of inflation. And at the same time, you've got to be flexible. You've got to be able to ride through the turbulence of these financial markets. And that's what we're built for. Experience is one of those things that you really don't value until after you acquire it. And at this point in my career, as I am mentoring and working with an amazing group of really talented people, far more talented than I was when I was their age. All I've got is experience that I can impart to them now. But they're in their 30s and they've never experienced inflation. They have no idea how you navigate an environment like this. We were very, very out of phase by not owning bonds. And yet regulators criticized us. Our peers in the industry criticized us. Everybody was just puzzled by that. But we've got a blank sheet of paper now that we can invest and rebalance our accounts appropriately based upon the new market realities. So we're built for this. We're ready to meet these challenges. And, we've stepped up the communication. I knew when Grant and I made this big move in January, we would have loved to have done it in November, December, but we didn't want to generate any more capital gain than we needed to in 2022. We've got modest amounts now here in 2023. We will work for the entire year to minimize the impact of taxes on the gains that we have taken. And we knew that we just knew there was going to be turmoil. We didn't know where it was coming from. To say that we could have predicted something like SVB Bank, we weren't, buried in their financials because we don't cover the company, but it happened. And it's always something where you least expect it. Federal Reserve was caught off balance. The regulators were caught off balance. Essentially, the world was. But we're prepared for it now. We knew something like this was going to happen. And so we had our first lunch and learn yesterday. We're going to continue to step up the communication. I just want to assure you, this is nothing new. We've been through these types of events in the past, and it's a very, very manageable thing. It's an exciting time for us because in addition to being well positioned, we believe that there'll be some resolution to the GSEs that will have a tremendous impact, positive impact on your accounts. It's like an old asset just been sitting in a drawer right now doing nothing for you, and then all of a sudden, you're going to find you had a Picasso sitting in the drawer, and it will have a big impact. So that's something we'll look forward to. We've also been working very hard on that. So I think it's going to be an exciting breakout year for us, for you, and we're committed to keeping you informed as we go. So that answers the question, why we do what we do. It's inflation, and we've got a handle on it. We've been here before, and we will guide you through it. Have a good day.